Hello and welcome to the Friday market update. So we're in day 17 of the government shutdown, but mortgage rates still keep creeping down. They're at 6.23% for a conventional mortgage and at 5.99% for FHA, according to Mortgage News Daily, my favorite website. So that's the lowest we've seen in nearly a year. We do have some data coming out next week, which is a CPI, which is what the government definitely looks at. But the BLS, the Bureau of Labor Statistics, is shut down. We're not going to get any new information. But next week, the 28th and 29th, is when the Fed meets again. And because there's a lack of data, the rates are just continuing to come down. What they have right now is telling them that the market isn't as strong as it was. Jobs are a little bit lower. They've been negative for 3 months out of the last 4, and it's just continuing to slip downwards. So we're not far from dipping below 6% on the conventional loans for the first time since September of 2022, over 3 years ago. Will that trend continue? Man, I sure hope so. So that brings me to the spread. And what in the heck is the spread? So mortgage rates typically move in lockstep with a 10-year treasury bond. And even though the mortgage term is 30 years, the average loan is refinanced, paid off, or sold in about 7 to 10 years, which makes the 10-year treasury kind of the ideal benchmark. So when the 10-year moves up or down, mortgage rates typically follow. The spread or margin above that 10-year treasury represents the added risk of return for the investors that they want on top of the treasury yield. Mortgages are riskier than U.S. Treasuries because they're backed by people. They're backed by individual borrowers instead of the big U.S. government. So investors charge a little bit of a premium, and that's called the spread. Now, over the past 25 years, the average spread has hovered around 1.7% to 1.8% over the 10-year Treasury. But during the volatility over the last few years, it ballooned to 3.1% in June of 2023. So to put that in perspective, mortgage rates were about 7% in June 2023. And if the spread had been the average of 1.8% instead of the 3.1%, rates would have been closer to 5.7% in June of 2023 instead of 7%. Now that's a massive difference. Now today that spread is definitely coming down. It's down to around 2.3%. So with the 10-year Treasury now sitting at about 4%, adding the spread of 2.3%, it puts mortgage rates right around where they are today at about 6.3%. So if that spread keeps shrinking down to 2% or below, or even get to the average of 1.8, even with no movement in the 10-year Treasury bond, rates would be near or below 6%. So we believe that spread will continue to shrink. And during our Friday playbook live on Zoom this morning, every Friday, join us. Sam predicted that conventional rates could hit 5.25% by the end of 2026. I agree. I concur. And if that happens, FHA and VA rates could fall into the high 4s, especially with the additional Fed fund rate cuts expected later this year, 1, possibly 2 rate cuts this year, and into 2026. Once conventional rates break that psychological 6% barrier, the media is going to amplify it and tell buyers sitting on the sidelines they're going to start to jump in. But smart buyers today, they don't wait for the headlines. They act now. So right now, sellers are still offering strong concessions, big concessions, like seller paid closing costs and 2-1 buydowns and permanent rate buydowns. We just locked a $275,000 purchase at 5.125% on an FHA loan, with the seller paying $16,500 on a $275,000 purchase in closing costs. This is a type of deal that's going to shrink as rates drop and competition heats up and those millennials buy in. Now remember, the average age of a first-time home buyer is 38 years old. These millennials are getting gray hair, having kids. They're moving out of mom and dad's house and they want a home. Over 50% of mortgage applications come from first-time home buyers, but they only make up less than 25% of actual purchases, which is way down from the usual. These buyers are ready. They just need affordability to line up for them to jump into the marketplace. And as rates drop, that affordability will line up. Now, speaking of first-time homebuyers, I would be remiss in letting you know that I'm hosting our Winning with First-Time Homebuyer seminar next Thursday, October 23rd. It's filling up quickly, but we'll give you all the tools, strategies, and messaging to work this massive pent-up market so you can win with first-time homebuyers. So let's go. Until next week, this is Gaylord out.